If you had to own a bond for the next 10 years, but you were absolutely forbidden from checking the price even once, would you still buy it?
That is a question that stops you in your tracks.
Right.
It instantly changes the entire concept of what we call income investing, doesn't it?
It has to.
Because if you can't lean on the market's daily reassurance, if you can't, look at a screen and see a green arrow, you have to lean on something much sturdier.
Exactly. You can't rely on the vibe of the market. You can't rely on what CNBC is saying this morning.
No.
You have to lean on standards, clear, written standards that tell you what safe enough actually means.
And that is exactly where we are going today.
Welcome to Capital Allocation Lab. This is the channel where we build disciplined, long-term investing judgment by revisiting the classic books and translating them into practical decisions for today.
It's great to be here.
If you like calm, audio-first lessons like this, where we focus on fundamentals, not forecasts, please subscribe and like to support more educational episodes. And if you know a fellow long-term investor who'd enjoy this, share it along.
And before we dive in, one quick reminder. This is educational content only.
That's right.
Nothing here is individualized investment, legal, tax, or accounting advice.
Okay, today we are digging into a core idea from Security Analysis by Benjamin Graham and David Dodd.
Yes.
Specifically, we are looking at Chapter 8.
Which covers specific standards for bond investment.
And what I love about this is that the theme is surprisingly modern. It feels like it could have been written yesterday, even though the language is, from the 1930s.
It really does.
Yeah.
The core message is that if you are going to invest for income, and we mean straight investment, not speculation, you need definite standards of safety.
Definite standard.
Not vibes, not headlines, and certainly not just the rating looked fine. You need standards.
And we are going to make this practical. We're going to look at why conservative bond selection is mostly a process of exclusion. We'll talk about safe lists, foreign bond risks, and why size matters.
And the goal is to help you build a personal bond checklist, something you can use whether you buy individual bonds, analyze bond funds, or just want to understand what high grade is supposed to mean.
So let's start with the big principle. Graham and Dodd are pretty blunt here.
They are.
They say that choosing high-grade bonds is, in large part, a process of exclusion.
This is such a critical mindset shift. In the stock market, we are often trained to be hunters.
Right. Looking for the next big thing.
We are looking for that one hidden gem, the needle in the haystack that's going to go up 10x. But in bond investing, the main job is not to find the clever gem.
No.
It's to systematically disqualify issues that don't deserve conservative capital.
It's a process of saying no.
Exactly.
Yeah.
Exclusion can sound negative, but it's really the core of risk management.
But hold on, isn't that a bit pessimistic? If I'm an investor, don't I want to find the best opportunities?
Of course.
Why act like a bouncer at a club, just denying people entry?
Because the math of a bond is fundamentally different from a stock. We have to talk about asymmetric risk.
Okay, let's break that down. Walk me through the math.
Think about the payoff. Let's say you buy a bond for $1,000 that pays a 5% coupon.
Okay.
If everything goes perfectly, the company does amazing, profits triple, they invent a cure for the common cold, what do you get?
I get my $50 a year, and I get my $1,000 back at the end.
Exactly. You get your coupons and your principal, no more. The upside is capped.
Completely.
You don't participate in the moonshot. The company's success doesn't make your check any bigger.
Right. I'm the lender, not the owner.
Precisely. But if things go badly, if that company fails,
I lose the $1,000, or a big chunk of it.
the downside is brutal. Missed payments, forced restructurings, long legal battles, or even a permanent loss of principal.
So it's all risk, very little reward, relatively speaking.
Well, looking at it mathematically, your upside is a fixed small percentage. Your downside is 100% of your capital.
When you put it that way, it sounds like a terrible bet unless you are incredibly sure about that capital preservation.
That is the point. The investor's job is asymmetric. You aren't trying to identify the best possible outcome. You're trying to avoid the outcomes that ruin the whole plan.
Right.
You make a mistake in a stock, a 10-bagger can pay for 10 mistakes. In bonds, one default can wipe out the interest income from 20 good bonds.
Ouch. That puts it in perspective. You have to win 20 times just to pay for losing once.
That is why definite standards matter so much. They reduce the chance that you talk yourself into a fragile bond just because the story felt comforting or because the CEO was charismatic.
Or, let's be honest, because the yield looked like a free lunch. We've all been there.
Oh, absolutely.
You see something yielding 8% when treasuries are at 4%, and you think, I'm a genius.
That is the classic trap. In credit, high yield is usually payment for a real risk. Sometimes a risk you don't fully see until the cycle turns.
And for the audience, we serve long-horizon investors who want to sleep well. Your bond bucket is often the ballast of the portfolio.
It is the part that keeps the ship upright when equities get stormy, which means a bad bond decision can actually do more harm than a bad stock decision.
That's an interesting take. Why is it worse? I mean, losing money is losing money, right?
Financially, yes. But psychologically, it breaks the stabilizer.
Ah.
If your safe money turns out to be not safe, the whole psychological and financial architecture gets shaky.
I see.
It causes more emotional damage because it breaks the investor's mental model. You panic sell everything because you feel like the floor has fallen out.
So it moves us away from shopping for yield.
Correct. For straight investment, the hierarchy has to be different.
Okay.
First, safety principle. Second, reliability of income. And only then, third, the rate.
That ordering, safety, reliability, then right is the psychological anchor for everything that follows.
It has to be.
Once you accept that, it becomes logical to apply definite rules, minimum standards that an issue must meet or it's out.
And historically, those minimum standards were literally written into law for certain institutions, like savings banks and trust funds.
This part of the source material is fascinating to me. The idea that society acknowledged that fiduciaries need guardrails.
Yes. When people are investing other people's money, depositors, beneficiaries, the law recognized that you can't just say be prudent and hope for the best.
Right.
You need strict rules.
It's basically protecting us from ourselves.
It tries to protect ordinary savers from the temptation, sometimes the institutional temptation, to reach for a little extra yield and quietly accept a lot of extra risk.
But Graham and Dodd make a provocative move here. They look at these laws for banks and say, if it's logical to have strict standards for institutions, why should individuals be looser?
That cuts against the common attitude we see even today, which is a bank must be conservative, but I can take more risk.
Sure.
Graham and Dodd challenge that. They argue that the ordinary investor often cannot afford big losses any more than a savings bank can.
And in some ways, the individual is less able to recover from a serious mistake. A bank has ongoing cash flow from thousands of loans. I have my savings.
Especially if that bond was bought for safety and income. If you are retired, living on that income, you cannot simply earn it back.
The text mentions a specific historical backdrop, the period since 1928.
Which is a polite way of saying the crash and the Great Depression.
Right.
During that period, a lot of things that people thought were safe turned out not to be safe at all.
So the authors argue for a tightening of investment standards, and they propose a simple method for straight bonds. Confine selections to those that meet legal tests of eligibility for savings banks or trust funds.
Now, they don't present this as perfect. They present it as a practical way to push investors toward what they call unimpeachable soundness.
It reinforces their broader principle. Inferior grade securities should only be bought on an admittedly speculative basis.
In other words,
Yeah.
call the thing what it is.
Yeah.
If you buy a weaker bond, don't label it investment just because it has a coupon.
Okay, so let's dig into these standards. They look at the New York Savings Bank law as a point of departure.
And New York statute was widely regarded as one of the best at the time. But the authors are clear. Even the best statute is imperfect.
They mention that state laws are divergent, antiquated, and not fully scientific.
Right. Legislators weren't writing a universal textbook for investors. They were writing rules for specific fiduciaries.
I see.
So the takeaway is not copy the law blindly. It's learn from the law, but think for yourself. Use it as a guide, not a final authority.
This sets up a really useful framework. The law's requirements can be grouped under 7 heads of analysis.
Right.
And I want to actually spend a minute on this list because often we gloss over these terms, but they really map the terrain of bond investing.
I think that is a great idea. Even if we only focus on the first 2 today, listing all 7 shows the rigor involved.
Let's run through them. Number 1, the nature and location of the business or government.
This is basically, who are they and where do they live? Are they a utility in Ohio or a government in South America? The rules of the game change based on that answer.
Number 2, the size of the enterprise or the issue.
Is this a lemonade stand or a global conglomerate? We will talk a lot about why size is a proxy for resilience.
Number 3, the terms of the issue.
This refers to the contract itself. When does it mature? Is it secured by collateral? What are the covenants? All the fine print.
Right. Number 4, the record of solvency and dividend payments.
Essentially, do they pay their bills? Have they ever defaulted? And have they been profitable enough to pay dividends to shareholders, which acts as a buffer for bondholders?
Number 5, the relation of earnings to interest requirements.
This is the classic coverage ratio. If I owe $1 in interest, do I earn $2, $5, or $10? The higher the better.
Number 6, the relation of the value of the property to the funded debt.
Funded debt is an old-school term for a long-term debt, usually bonds.
Okay.
So this asks, if we had to sell all the buildings and machinery, the property, would it cover the debt?
And finally, number 7, the relation of stock capitalization to the funded debt.
This is the market's view of safety. Stock capitalization means the total market value of the company's equity.
The equity cushion.
Exactly. If the stock is worth $1 billion and the debt is $100 million, there is a massive equity cushion beneath you. If it's the reverse, you are in trouble.
That list is a masterclass in bond analysis priorities. It's not about stories. It's about structure, capacity, and coverage.
It really is.
Today we are camping on the first 2, nature and location and size, because there is more subtlety there than most investors assume. Let's start with nature and location.
One of the most striking features of those old savings bank laws was the blanket exclusion of certain categories of bonds.
New York's permitted versus prohibited classes. Let's look at the list. Admitted: U.S. government, state and municipal bonds, railroad bonds,
Okay.
certain public utility mortgage bonds, and bonds secured by first mortgages on real estate.
Those were the golden children.
And then look at what was excluded. Foreign government and foreign corporation bonds, street railway and water bonds, debentures of public utilities, all industrial bonds, and bonds of financial companies like investment trusts.
That is a sweeping set of exclusions. I mean, just massive categories wiped off the board.
Just to pause on debentures for a second, can we Eli 5 that?
Sure. A debenture is simply an unsecured bond. It means there is no specific collateral, no factory or train track pledge to back the loan.
Okay, so you're just a general creditor.
You are relying on the general credit of the company. The New York law said, if it's a utility, we want a mortgage, we want collateral.
Got it. But the one that jumps out at me is all industrial bonds. That sounds insane to a modern ear.
It does.
That means Ford, GM, U.S. Steel, or today, Apple and Microsoft, all excluded.
Under that specific 1930s framework, yes. They were considered too cyclical, too risky for widows and orphans.
So it's not we require higher margins, it's we just don't go there, a complete no-go zone.
So we have to ask, is that kind of blanket prohibition sensible? Graham and Dodd say. Be careful.
Right.
Investment theory should be chary of easy generalizations.
Even if you accept that certain categories are generally more unstable like industrial bonds, eliminating an entire major group is neither practical nor desirable.
Because reality isn't clean. Even in unstable categories, a minority of issues may have proven their investment status through severe tests.
So you throw the baby out with the bathwater.
You do. If you exclude everything industrial, you might miss the rare industrial issuer that actually behaves like an investment-grade utility.
But I can see why the lawmakers did it. It simplifies the job.
Oh, for sure.
No industrials is easier to enforce than check the debt-to-equity ratio of every factory.
True. But the authors also flag a second-order effect of these lists that feels extremely modern.
Which is what?
Scarcity.
Yes. If you confine investment demand to a narrow set of eligible types, you create scarcity in those bonds.
And scarcity changes behavior.
It leads investors to accept inferior issues merely because they fall within the favored group.
Merely because they fall within the group. That is the key phrase.
It's just a label.
Imagine everyone is forced to buy only railroad bonds. The good railroad bonds get bought up instantly. Their yields crash. So investors, desperate for yield, start buying the bad railroad bonds just because they have the label railroad.
So the safe list actually makes people buy unsafe assets.
Exactly. When rules are categorical, people start optimizing around categories instead of around underlying safety.
This creates a situation where yields get compressed for eligible bonds, which tempts issuers to game the system.
They try to cram themselves into the eligible structure, sometimes using legal form over economic substance just to get on the list.
We see this today, don't we?
Absolutely. Think about investment-grade only mandates. When a large pool of capital like a pension fund must buy anything rated BBB or higher, the BBB boundary becomes a cliff.
And the temptation is to live right at the edge of that cliff.
Exactly. Companies will engineer their balance sheets to have maximum leverage that still just barely keeps the BBB rating.
Fascinating.
That's why Graham and Dodd's principle is so timeless. Don't outsource your standards to a category, a label, or a list.
Right.
Use the list as a starting universe, then apply your own conservative filters.
So Graham and Dodd propose a better principle. Individual strength may compensate for the inherent weakness of a class.
That is a big deal.
Yep.
It doesn't deny that some classes have higher baseline risks.
Sure.
It just says, don't stop thinking at the category label. Instead, require a stronger exhibit from the individual bond when the class is weaker.
For example, an industrial bond might properly be required to show a larger margin of earnings over interest charges and a smaller proportion of debt to going concern value than a bond from a gas or electric enterprise.
That one concept is basically the blueprint for modern credit differentiation.
Let's make that concrete. Suppose you have two issuers. Issuer A is a regulated utility.
Okay.
Issuer B is a cyclical manufacturer.
Okay. The utilities revenue is relatively stable, and regulation can provide rate relief over time. They have a monopoly in their area. People need electricity even in a recession.
Sure.
The manufacturer's revenue can swing hard with the economy.
So if both issuers have the same interest bill, let's say $20 million a year, you would want very different buffers.
Right. If the utility reliably earns, say, $100 million before interest, a 5 times coverage is meaningful.
Yeah.
That $100 million is unlikely to drop below $20 million.
Pretty stable.
But for the manufacturer, a good year might be $120 million.
Which looks better. That's 6 times coverage.
But a bad year might be $40 million.
In that case, 5 or 6 times coverage in the good year is misleading.
Totally misleading. Coverage must be judged across the bad year.
The trough.
If the bad year drops to $40 million, then that $20 million of interest is only 2 times coverage. That is getting uncomfortably close to the edge.
And that is when covenants get tight and refinancing gets scary.
The point isn't the exact numbers. The point is that the same ratio means different things depending on stability.
Right.
A definite standard is a threshold adjusted for the character of the business. You need a bigger airbag if you are driving on a more dangerous road.
There's also a detail in the text about water company bonds. New York excluded them, but other states treated them as comparable to gas and electric.
The authors say there's no good reason to subject them to more stringent requirements. It's another warning against blanket rules. Categories can reflect politics or history, not careful analysis.
The story gets even more interesting with the 1938 amendment to New York's banking law. The legislature recognized these categorical exclusions were a problem.
But they tried to solve it in a peculiar way. They allowed the banking board to authorize investments in obligations not otherwise eligible, provided a certain number of savings banks applied for that authorization.
In effect, the amendment could supersede many of the specific requirements of the law by agreement between the banks and the banking board.
Graham and Dodd note, there is no practical danger that all rules would be flouted, but there is something conceptually odd about writing a long list of rules and then allowing an administrative body to waive them.
It brings up the rule versus discretion debate. Do we stick to the rigid text or do we trust the experts?
Which is still with us. Their suggestion is elegant. Prescribe a few really important criteria that must always be followed.
The non-negotiables.
And then give a conservative authority discretionary power to exclude issues that technically meet the minima, but still aren't sound enough.
That is the deeper lesson. Build a small set of non-negotiable safety standards, but reserve the right to say no, even when the box is checked.
Precisely. You want the checklist to filter out the junk, but you still need judgment to pick the gold.
Now, moving on from domestic bonds, the text pivots to foreign government obligations, and the logic changes completely.
It does. The authors basically say, a usual financial analysis has limited traction here.
Why is that? I mean, a balance sheet is a balance sheet, right?
Yeah. Not when the borrower has an army. Because a foreign government bond depends heavily on intangible factors.
Such as?
Confidence in the country's economic and political stability, and the belief that it will faithfully endeavor to discharge its obligations.
It sounds like we're analyzing willingness as much as ability.
We are. With a domestic corporation, you can analyze earnings, assets, covenants, liens, and legal remedies. With a sovereign, you are analyzing politics.
There is a core line in the text. In the final analysis, a foreign government debt is an unenforceable contract.
That is a stopper. If the country doesn't pay, the bondholder has no direct remedy.
Let's translate unenforceable contract. With a domestic corporate bond, if the company doesn't pay, you have a legal process.
It might be slow, it might be imperfect, but it is real. You have a judge, you have bankruptcy court, you can force them to sell assets.
Right.
With a foreign sovereign, the legal process can exist on paper, but the practical ability to compel payment is limited. Who are you going to sue? The king, the parliament.
And who will enforce the judgment?
Damn it.
Which turns the credit question into two questions. Can they pay, and will they pay?
And those can diverge. A country might have resources, gold in the vaults, oil in the ground, but prioritize domestic stability or political goals over external creditors.
Or they might be willing in principle, but constrained by crises that force capital controls.
So for straight investment money you truly depend on, this adds a category of uncertainty that standard financial ratios cannot fully resolve.
Does that mean never buy foreign bonds?
It doesn't mean never. It means if you do it, you need to treat the decision as exceptional. Even if specific revenues or assets are pledged, the bondholder can be practically helpless if those pledges are broken.
The text mentions political expediency.
Yes. Theoretically, the bond is a claim against the entire resources of the nation. But practically, how much of those resources get used to pay external creditors depends on politics. If paying the foreign bondholders means cutting food subsidies for your own angry population, what is a politician going to do?
They're going to default.
Exactly. Default becomes a policy choice.
And they note something psychologically important. As defaults become common, the shame decreases.
Which reduces the deterrent. If default is rare, it's reputationally catastrophic. A country would move heaven and earth to avoid it.
Right.
If default is common, it becomes just another policy choice. Everyone else is restructuring. Why shouldn't we?
Then we get the foreign trade argument. The idea that international lending is necessary to restore world equilibrium and support export trade.
Right.
This was big in the 1920s, right? Bankers saying, we have to lend to Europe so they can buy our exports.
Graham and Dodd respond with a tough love position. Investors should not be expected to make unsound commitments for idealistic reasons or to benefit exporters.
But isn't that a bit harsh? I mean, aren't there times where international lending does actually help stabilize the global system? Yeah. Why is Graham so cynical here?
He isn't being cynical. He is being a fiduciary. He is saying, if you want to donate to global stability, go ahead, but don't call it investment. If an investment requires you to accept bad risk-return terms for the greater good, it isn't an investment. It's charity.
Or policy.
Right. And they distinguish speculation from investment. Buying distressed foreign obligations at low prices might be justified as speculation because the payoff could be large.
But those depressed prices are also an argument against later buying new foreign issues near par just because the coupon looks high.
Exactly. A high coupon doesn't erase the fact that markets once priced the same country's credit at deep discounts.
Next, they explore the individual record argument, the claim that some nations deserve high credit ratings based on past performance.
This country always pays.
Right. Some states even recognize Canada's standing by authorizing savings banks to purchase Canadian obligations. But the authors push back with evidence. They classify countries with dollar debts according to how their bonds behaved during the severe test of 1932.
This is a brilliant approach. Use crisis pricing as a reality check.
Yeah.
Not how they behave in good times, but did they crash in the bad times?
Yeah. In their classification, the countries whose bonds sold on an investment basis included Canada, France, Great Britain, the Netherlands, and Switzerland.
That sounds like a solid list.
But there is a catch. Of those 5 countries, the credit of 2, France and Great Britain, was considered speculative in the earlier depression of 1921-1922.
So their record isn't spotless.
So over a 12-year period ending in 1932, only 3 countries, Canada, Holland, and Switzerland, enjoyed an unquestioned investment rating.
That is not an argument that every foreign bond is doomed. It's an argument that the base rates of truly dependable credits are surprisingly small.
So the conservative default posture should be avoidance. Treat foreign sovereigns as exceptions, not routine income investments.
Their conclusion is conditional. They say it would require a long period of punctual discharge of international obligations to justify a more favorable general attitude.
They do carve out an exemption for Canadian issues.
Based on both record and the closeness of the relationship between Canada and the United States.
They also allow that individual investors may, for personal or statistical reasons, be convinced about other countries.
Right.
But the guidance remains conservative.
Approach them as exceptions to a general rule of avoiding foreign bonds and require exceptionally strong evidence of stability and safety.
Now let's go one step further. Bonds of foreign corporations. If I buy a bond from a German or Brazilian company, is that safer?
In theory, they argue, a corporation's bonds cannot enjoy better security than the obligations of the country where the corporation is located.
The ceiling theory.
Right, because the government's taxing power is an unlimited prior claim on assets and earnings.
Okay.
In a pinch, the government can essentially redirect resources.
But in practice, there are limits. Political expediency again. So you can have cases where companies meet their dollar obligations even when their government defaults.
Foreign corporate bonds also have an advantage over sovereign bonds. Specific legal remedies, like foreclosure. So a foreign company may be under greater compulsion to pay. If they don't pay, you can take their ships or their factories, assuming the local law lets you.
But, and here's the key but, the conditions that cause a government default are likely to harm the corporate bondholder too.
Exchange controls or restrictions on fund transfers can prevent the payment of interest in dollars, even if the company remains solvent in local terms.
Can we explain that? Exchange controls.
Sure. Imagine a company in country X makes a huge profit in their local currency. They want to pay you, here in New York, in dollars.
Right.
But country X has run out of dollars. The government steps in and says, nobody's allowed to convert local currency to dollars. We need the dollars for medicine and fuel.
So the company is rich, but I'm broke.
Exactly. The company is solvent, but your bond is in default.
And the distance plus obstacles created by governmental decrees can destroy the practical value of mortgage security.
So the conclusion is basically, the unfavorable view of foreign sovereign bonds as fixed value investments applies in large part to foreign corporate bonds as well.
Okay, so we've established that domestic bonds rely on law and foreign bonds rely on politics. But surely a tiny domestic utility isn't the same as a massive one. This brings us to the next filter, size.
This part is deceptively simple, and that's why it's powerful.
Let's do a quick thought experiment on size. Imagine two towns issuing municipal bonds.
Okay.
Town A has 2,000 residents and one major employer, maybe a big lumber mill.
And Town B has 200,000 residents and a diversified tax base, healthcare, education, services, light manufacturing.
Now picture a recession. Town A loses that one employer, the mill closes.
The impact is catastrophic. Unemployment spikes to 50%. The tax base collapses.
Gone.
Property values tank, so property tax revenue vanishes. Every budget decision becomes a crisis. They literally might not have the cash to pay the bond interest.
Town B still suffers. They have a recession too.
But it has multiple levers. If the factory slows down, the hospital is still running. The university is still open. They have broader property taxes, diversified employment, larger reserves, and usually better access to capital markets.
That is the essence of the minimum size idea. You aren't predicting a specific shock. You are choosing issuers that have more ways to survive the shock you can't predict.
The same works for companies. A small issuer might have one product line, one key contract, one bank relationship. A larger issuer often has multiple revenue lines, deeper access to lenders, more operational redundancy.
Hold on, though. Isn't size a lazy metric? Enron was huge. Lehman Brothers was huge. Does size actually equal safety?
It's not a guarantee. That is a crucial distinction. None of this guarantees safety.
No, but it reduces fragility. The bonds of very small enterprises are subject to objections that disqualify them as media for conservative investment.
A small company is more vulnerable to unexpected shocks, loss of a customer, a lawsuit, a supply disruption.
Right.
If you only have 3 big customers and one leaves, you're in trouble. If General Electric loses one customer, it's a rounding error.
And small companies often lack strong banking connections. In a crisis, those relationships matter. Historically, very small businesses didn't obtain public bond financing. They relied on private capital.
Which usually came with a voice in management.
Which makes sense. If you are funding a fragile enterprise, you want equity-like upside and control rights, not just a fixed coupon.
But here's the uncomfortable part. Minimum size standards require arbitrary lines.
You can't mathematically prove the exact point at which an issuer becomes large enough. It's a rule of thumb.
Is a town of 9,000 people unsafe, but 10,001 safe?
No, of course not.
But you have to draw a line somewhere.
So what did the New York statute require? Let's look at the numbers. And when we read these, let's keep in mind these are 1930s dollars, so the absolute numbers will sound small, but focus on the relative requirements.
Right. For municipal bonds, it required at least 10,000 population for states adjacent to New York.
Okay.
And 30,000 for other states.
Wait, why the difference? Why is a town in New Jersey safe at 10,000, but a town in California needs 30,000?
It's the home field bias again. The idea was that closer municipalities were easier to monitor and enforce.
For railroads.
Either ownership of 500 miles of standard gauge line or operating revenues of at least $10 million per year.
And for railroad income bonds.
Net income available for dividends had to be at least $10 million.
Gas and electric.
Gross revenues averaging at least $1 million per year for 5 years.
Yeah.
And the bond issue size itself had to be at least $1 million.
Telephone.
Gross revenues of $5 million. And bond issue size at least $5 million.
That is a lot of numbers. And looking at them, 10 million for a railroad versus 1 million for a utility? Why the discrepancy?
Graham and Dodd critique them pretty directly. They say the gross receipts thresholds don't look well chosen. The railroad requirement was incredibly high for the time.
They say the $10 million gross requirement for railroads is too high. It excluded some lines that actually showed strong resilience in depression conditions.
And the telephone requirement, $5 million, looks unwarranted when compared to gas and electric at $1 million. Why does a phone company need to be 5 times bigger to be safe?
They even note a case where a smaller telephone company's bonds were of unquestioned merit, yet the rules screened it out.
This is a great reminder. Screens should be judged by false positives and false negatives. A standard that feels conservative can still be poorly calibrated.
So Graham and Dodd proposed their own simplified minimum requirements for size.
Okay.
The suggested minima are municipalities with 10,000 population,
Public utility enterprises,
$2 million gross,
railroad systems,
$3 million gross,
and industrial companies.
$5 million gross.
Notice the structure. Keep it simple, keep it interpretable, and tailor it to the business type.
Industrial bonds are a special case because the New York law excluded them, so it didn't even specify minimum size.
Graham and Dodd take the view that industrial obligations can be included among high-grade investments if they meet stringent tests.
But experience suggested that dominant, or at least substantial size, provides extra protection against industrial instability.
They suggest a cautious investor might confine purchases to perhaps the half-dozen leading units in each industrial group and maybe add the minimum annual sales threshold.
This is where a forward-looking perspective matters. Scale can provide resilience. So in industries subject to rapid competitive change, you want issuers with structural stability.
The authors also anticipate a criticism. If these standards were universally applied, moderate-sized but sound businesses might be unable to finance themselves with straight bonds.
That is true. If everyone demands giants, the mid-sized companies starve.
Right.
Stricter standards can push more issuers toward equity, hybrids, or private capital.
But Graham and Dodd are willing to accept that trade-off. Their job isn't to make the financing market convenient for issuers.
No.
Their job is to keep the investor out of trouble.
They do add a crucial caveat. Large size alone is no guarantee of safety.
That is worth underlining. The biggest company can be the weakest if bonded debt is disproportionately large.
Sure.
A giant with too much debt is just a giant bankruptcy waiting to happen.
In railroads, utilities, and municipalities, they argue there is no special advantage to the very largest units compared with medium ones. Beyond a threshold, size doesn't materially change bond safety.
A town of 75,000 can deserve better credit than a city of several million.
Which is a reminder that scale and credit quality are correlated only loosely. What matters is resilience, not bragging rights.
They also reject some other statutory provisions. One is the minimum size of the bond issue itself.
They point out the logical fallacy. If the enterprise is large enough, a smaller bond issue should be easier to service, not harder.
The legislature probably cared about marketability.
But Graham and Dodd say marketability is given too much stress by investors. They don't favor that requirement as a general rule.
This is a subtle but important point. Many people equate liquidity with safety.
Let's unpack the marketability point a little more. Marketability and how easily you can sell at a fair price today.
Right.
Safety is about whether you will be paid as promised over time.
They are related, but not identical. In calm markets, liquidity feels like safety. In stress, liquidity can vanish.
Good point.
That is why a conservative investor should avoid using liquidity as the primary safety test.
Instead, decide your holding intention first. If you hold for income, you can afford to prioritize underlying strength over constant tradability.
Exactly. If you plan to hold to maturity, who cares if it trades thin on a Tuesday?
Let's translate all this into a practical checklist. We will keep it aligned with the chapter spirit, exclusion first, and definite standards.
Yeah.
Here is a simple three-part screen.
Let's apply it to a few hypothetical examples.
Example 1. A domestic regulated utility bond.
Jurisdiction and enforceability. Strong, familiar legal framework. Category. Generally stable. Size. Typically above any minimum threshold.
That doesn't automatically make it safe, but it passes the first gate. Then you would move on to the other heads, terms, coverage, leverage.
Example 2. A foreign sovereign bond with a very high coupon and a glossy prospectus.
Jurisdiction and enforceability.
Weak in practice. The credit hinges on political expediency. That alone should trigger exception status.
Meaning, if you buy it, don't put it in the same mental bucket as your conservative income holdings.
And demand a higher margin safety, possibly in price, possibly in position size, and certainly in your expectations.
Example 3. A tiny municipal bond from a very small locality.
It might be domestic, but size fails. The tax base is fragile. Avoid.
These examples show how standards simplify decision-making.
They don't finish the analysis, but they prevent you from wasting time and capital on obvious mismatches.
So part 1, jurisdiction and enforceability. Asked, what is my realistic remedy if the issuer stops paying?
Domestic sovereign and municipal obligations are different from foreign sovereigns in enforceability. For foreign sovereigns, recognize that payment can hinge on political expediency more than financial ratios.
Part 2, category and stability. Ask, what is the inherent stability of this business class?
Regulated utilities tend to have different stability characteristics than cyclical industrial companies. Don't confuse stable last year with structurally stable.
Right.
And if the class is inherently weaker, raise the bar.
Part 3, minimum scale. Ask, is the issuer big enough to be resilient?
Use simple, reasonable minima. Remember, these are rule of thumb. The goal is protection against obvious fragility.
And remember the caveat, size does not substitute for balance sheet strength.
A huge but over-levered enterprise can still be dangerous.
Now, because this is Capital Allocation Lab, we always try to connect a concept to decision quality. So here are 3 practical next steps for a listener.
First, write down your non-negotiables.
Literally, a one-page list.
The moment it stays only in your head, it becomes negotiable under pressure. Decide what categories you generally avoid for straight investment, and under what conditions you treat something as an exception.
And be explicit about foreign exposure.
If you choose to accept it, define what exceptionally strong evidence means to you.
Second, separate income from investment.
If you buy a bond, mainly because the yield is high, label it honestly. That helps you size it appropriately and avoid mixing it with money meant to be safe.
The psychological benefit of labeling is enormous. It prevents self-deception.
Third, remember that standards are dynamic, not because principles change, but because business reality changes.
Industries evolve, legal regimes shift, and financial structures get more creative.
Your standards should remain rooted in the same goal, safety of principle and reliability of income. But the way you apply them should reflect the current environment.
That is what we mean by revisiting classics for today.
We'll close by previewing what comes next in this framework.
Good idea.
In later discussions, the remaining criteria matter a lot. The terms of the issue, the issuer's record of solvency, the margin of earnings over interest, and how asset values and equity buffers relate to the debt.
Those are the levers that turn "this seems fine" into "this is genuinely protected."
And they're also the levers that help you avoid being dazzled by labels, ratings, and yield.
All right, let's wrap it up. Thanks for joining. You've been listening to Capital Allocation Lab. Our mission is to teach disciplined, long-term investing by revisiting the classic books and core ideas explained clearly in today's context, so you can make better decisions as an owner.
If you found this useful, like the episode and subscribe. It really helps us keep these lessons free.
And we'd love to hear from you. Leave a comment with a question, a pushback, or a real-world bond decision you're trying to think through.
Also tell us what fundamental investing concept you want next: margin of safety and credit, dividends versus buybacks, ROIC versus ROE, capital structure, or anything else you'd like us to unpack.
Thanks for listening, and we'll see you in the next episode.